everybody, Signet here with the Bullish Bears. So today I want to do a quick introduction to the diagonal trade. Now, the diagonal is a lot like a calendar. Oftentimes I end up putting it on for a credit. You don't need to. If you don't remember the way that the calendar works, we really just want to take advantage of the way skew works with the options. So our goal is to always sell the front option. So if you think about that, I'm selling a call. I'm bearish in the market. So I'm selling a call and I want to pay for it by buying. I want to spend that money that I get from that to buy a call back here. And when we combine those two, this is a really great trade strategy that I use when I'm trading a bear call or when I'm trading a flag. Right. So when you see a market kind of just rip parabolic to the upside, and you got that market parabolic move, oftentimes it'll reach a peak, run into some heavy resistance overhead, and as it bear flags, as it pulls back 2 maybe 3 days before ripping higher, in that 2 to 3 days is a really great opportunity to put on a diagonal trade. Now that's not the only time we trade it, and we can do like multiple trading strategies. There's so many ways to trade this, but what we want to do is we want to sell a front option and we want to buy one farther back, and that gives us our diagonal. Now I already had one over here that we could look at. This is SPY. This is a diagonal, and this is the tint. Right? Normally with a calendar, both sides would look like this. Right? But what we're doing is we're skewing one side. And the reason this is helpful, and you might have seen this when I was building calendars before, the reason we would do this is if we're looking for the market to move down. So you can see that right now we're at 289.61. That's right here. And I built it really close to the market this time. But typically we would want to see that market fade down into our butter zone. If it outruns us and continues to fall, then we'll just end up keeping the credit that we received for this trade. So you can see that this throws people off quite a bit. This is a negative credit. It's really just a credit. The negative sign is to warn you or to let you know that, hey, this trade has more than one option in it from a different expiration. And the reason for that is if I was to place this trade with, for an example, TD Ameritrade, when you're in a trade, TD Ameritrade will show a little icon here letting you know that you are in a trade. Now you can right click on that option and try to sell it, and if it's all in one series, if you right click right there, it'll ask if you want to sell this entire spread, whatever you happen to have built here. But when it's in multiple expirations, if you right click on it and tell it to sell it, it will only sell the option in that series, and it would leave this one floating out there all by itself. And so that negative sign is to warn you that, hey, this option isn't alone. This is a double, that these are in different expirations. So this is very much like a calendar. This would take advantage of volatility. You would not want to be in this trade and have volatility crushed in the marketplace. So these are not good for earnings trades. Earnings, we get vol crushed. But you always want to sell the front one and then buy the back one. If you do it the other way around, the marketplace is going to think that you're trying to do a completely separate trade, and they won't let you trade it if you can't cover that naked option. And that's how they will see it. They will see that if you tried to buy this option and sell this one, they will see this as a naked sell. And if you can't cover that naked call, they're not going to let you trade that. Right? So you can't sell a naked call unless you have the funds to ride SPY all the way to zero, which is how they will price that option. Right? If I go in here and confirm and send to sell, then you can see that that's what they would require. So we sell the front one, we buy the back one. And as I said, typically I end up getting them for a credit. That's where I have found the best edge. You don't have to. Say for an example, we looked at the 289 and then we looked at the 290. Well, even that one gave us a credit, so maybe the 288 and the 290. Wow, just getting really good today. So the 287 and the 289. Yep, no, I'm just really good. So it must be the way that the market is skewed today, or the price. I'm just hitting credits like crazy, but oftentimes you have to work to get a credit. They don't come that easily. It just must be my lucky day. So that is the trade. We do have very specific ways to trade this, or very specific time frames that we would want to trade this. This isn't one that we use often. A lot of people don't like this trade because you do not have a fixed amount that you can make, right? As volatility expands or contracts in the marketplace, your max profit can expand in the marketplace, and people don't like that, who trade with a very fixed risk reward ratio. They want to know exactly how much they have on the line and how much they can make in their trade. And this is fluid. It will adjust itself with volatility, and people don't like that. So this is, as I said, a representation of a calendar. A calendar is a time trade. The diagonal also can be considered a time trade. You don't want to skew these two spreads too far apart, right? So typically you want them a week to 2 weeks. I have seen a strategy where they are a month apart on monthly options, but that really is pushing the limit. I have never seen a trade strategy for a diagonal that it went past a month. And if you did gap these two by a month, you would want to be very far out in time to do that, right? You would want to go way out here. As I've said, I've never seen it done that far out, but it can be. I can understand the strategy and the logic behind that. This is a really great strategy once you become familiar with it. And on the Bullish Bears website, we do have very specific trade strategies to use this. So I hope you appreciate this video on the introduction to the diagonals, and I look forward to seeing you at the next video.